In this video, we're going to take you through the 16 most common mistakes first home buyers are making right now.
Including one tip that's costing first time buyers $11,850 over the life of the loan. So keep watching.
And remember to hit like and subscribe below.
The first mistake first time buyers are making are they getting a pre-approval. And this is a big one.
Yeah, Josh, we've found that a pre-approval these days isn't a promise.
Yeah, a lot of banks have changed the way they're doing pre-approvals, unfortunately, and they've sacrificed quality for automation and speed.
We saw it last year with ING, for example. Their timeframes blew out, and if you're doing an application, you're waiting weeks to get your loan approved because they were doing pre-approvals, refinances, purchases. They were just kind of treating everyone as equal. Fast forward to today,
they're no longer doing them. And you know what? The good news is that once you've purchased a property, banks like ING are now very quick. Back in the day, it was taking weeks for them to assess an application. Now, it's 2 or 3 days max.
The so what of all this is that they do a coffee shop pre-approval, which we've talked about in our videos before, but it's basically a fake. They just do a quick credit check. They don't look at your pay slips, your bank statements, your living expenses, nothing else. They say, yeah, Josh, you're totally fine. Go buy at auction and we'll worry about it later. What's the problem with that?
It essentially means that no one except a computer has looked at your application. So with most people, there's going to be one or two little things that the bank may or may not want more information on. Without having a fully assessed pre-approval, they're really not worth anything. As you said, they're not worth the paper they're written on. But there are ways to get around this. And looking at your lending eligibility has been never more important. So Jayden, let's talk about our process and what we do with our lending eligibility.
Yeah, so Josh, we've kicked it a bit old school.
Order the double cheese and sausage. Right here, dude.
We've gone back to the way the banks used to do it back in the day. We'll look at your credit file and make sure there's nothing naughty on there. That's a big thing at the moment because the banks are credit scoring pretty heavily. And we've covered in other videos, if your score doesn't meet all their criteria, if you've got missed payments, which shot for the last 2 years on your credit file, it's not gonna look good. We look at your bank statements, which is the other thing that banks forensically look through these days. They're checking out if you've done like super withdrawals, instant decline. They're looking for if you've got too much in gambling and sports bet, massive issues, because they say, well, Josh, you've been punting $200 a week for the last 52 weeks. We're gonna take that out as an ongoing expense and it's gonna reduce your borrowing capacity. Or we just think you're kind of a risky guy. They also look for how long have you had your savings in your statement. So they wanna see you holding onto your savings for at least 3 months and not see any big transfers where I'm just kind of giving Josh, $1,000 here or $2,000 there. They want to make sure it's my own money. Now, I have had questions on this before from YouTube. Thanks for asking that. It's okay if you're moving from say like ING to CBA to get a high savings amount. That's cool. They're more looking for if you're just transferring or getting money from mysterious sources that's not your own savings. What's some other stuff we look at in the finance process, Josh?
Yeah, so we'll be looking at your borrowing capacity and also your lending criteria. So if you're in a short-term employment, for example, if you're less than 6 months enrolled, whether or not that would be acceptable to the bank. In short, what it means is that instead of being wedded to a lender, that once you found a property, we can find you the best deal at that time. Who we recommend now and who we recommend in say 3 months time are two completely different things. The market's fluid, always changing, and by doing it this way, we can ensure that we get you the best deal once you're ready to move.
Yeah, completely true.
The next mistake is that first-time buyers are getting offset facilities, and this is a big concern because over the life of the loan, it's going to cost about $11,850.
Yeah, Josh, when I bought my first home, my parents told me, they're like, oh, Jayden, you've got to go to your bank, you've got to get a professional package, you have to get an offset account because it's a really clever way of doing it. You're going to save heaps of money and you're going to pay off that loan really quickly. And I'm like, okay, mum and dad, you've had a home loan, you totally know what you're talking about.
And the problem with this is that the banks are educating you to get their package. You pay a fee, usually around that $400 mark, and it means you're going to get an offset account. You're going to get a credit card, and all your banking suddenly goes to that bank you've applied with. There's a big problem with this there, isn't there, Jayden?
Well, it's more, it's just extra fees that you don't need to pay. Fortunately, in the last few years, the banks have been launching what they call basic home loan products. So St. George, ING, they've all actually got some really good ones where they've taken away that annual fee because they know people don't need it. What's the alternative to offset, Josh? Because if you want to make extra payments, can you do it without an offset account?
Absolutely, and it's a thing called redraw. So redraw and offset do the same thing, and it's essentially whatever money you've got available. you won't pay interest on. So
we have a whole other video on offset versus redraw. Josh did it. It's got some cool diagrams. Check that out in the links below.
The third mistake we see first-time buyers make is that they're not going in with a negotiation plan, and this is a big mistake.
Yeah, so the funny thing here is, well, we see it every day. A lot of first home buyers are really caught up in the, oh, I need to get my pre-approval. Without a pre-approval, I'm not gonna be able to get this home. But the reality is, if you pay the wrong price, you're gonna overpay for this place by like $10,000, $20,000, $30,000. So how do you work this, Josh?
As the old saying goes, if you fail to plan, you plan to fail. So essentially, real estate agents are playing games all the time. And the question is, if they're playing the game, why aren't you? So before going in there, a few tips to take out here.
Takeaway here is to do your own research and set your limit. You need to know what that property is worth, because more and more these days, the agents might give you a price guide. It might feel like it's really busy because lots of people are trying to go out and buy their first home, but the reality is you don't want to overpay for that property. So follow our video on the research process. And Josh, your last tip?
My last tip is that think of property like a busy bus stop. Know that there's going to be, if you miss a bus, there's plenty of other buses on their way. So all is not lost. The fourth tip is first-time buyers believing what the agent says. Jayden?
It's pretty easy to forget that the real estate agent isn't there working on your side. They're actually there to represent the seller. The agent's there to help themselves get a sale for the highest price possible.
Exactly right. And common things you're going to hear from real estate agents is that, hey, Jayden, we've got heaps of interest on this property. We've got another person about to make an offer. If you hear these sound bites, they're very common. They're going to say the same thing again
Josh,
and again.
the best, I've said this on another video, but I've got to say it again, was one, I had a client with a real estate agent that said, oh, I've got an offer in this envelope here. Now, I can't open this envelope and tell you how much the offer is. I can't tell you what it is, but there's another offer, so you better offer your best and final and go for your highest price because you're going to miss out. And it's just, how do you verify that? Like, it's just...
It's a mug's game. It really is.
It can be deceitful. We know real estate agents, that we know lots of honest real estate agents, so not everyone's like that, but you just need to be out there and be aware of what the market is, do your research, understand the price, and be prepared to walk away.
The next mistake is that first-time buyers go to auction. And this is a big one, particularly when you understand that really an auction is a rigged game. It's there designed to get the highest price for the seller.
Now, so I've got a few issues with auction, and because I see it literally every week. The first is everyone thinks they're going to get the biggest steal at an auction. Oh, they're going to sell for a loss and they're going to walk away and I'm going to get the cheapest house in the street and I'm so smart. Again, do your research. Find out what they actually paid for the place. Because if you think you're going to get it for 400,000, the median house price is 600,000 in a suburb, you're dreaming, unfortunately. The second thing that agents always do is they'll say, oh, Josh, make an offer before the auction. We're totally accepting offers before the auction. What's that all about? Tell us. Explain the auction mentality and why agents do this.
That's exactly right. It's a part of the educational process, and essentially what the agent's looking to do is position the seller that the property is going to sell for less than what it's worth. And essentially, when the property is worth, say, 700,000, and they're saying, hey, look, if you make an offer for 600,000, you're going to get this property before auction. It's not there to help you in any way, shape, or form. It's their design to educate the seller. So beware, be warned.
I think it's also there, you got to remember to sort of open up the kimono and show what you're going to offer on auction day. Because then it's like, well, Josh is at 600,000. All right, I'm not going to work him too hard. But Jayden's over here and he said he's going to offer 750. So we know that we're going to be able to pepper him up and push him up. And it's just not the greatest idea. In all the, I've seen like hardly any pre-auctions taken. So be careful.
The next mistake first home buyers make is that they borrow over the limit. And realistically, what we've got to remember is that this is a 30-year commitment. Like a marriage, you want to set yourself up for success to begin with and not go from the start over your limit. Jayden, what does this look like?
So the banks are assuming you're going to pay the loan off over 30 years. And realistically, by paying off slower, it's making the bank more money because the longer you have the loan, the more interest you're going to pay. The way you really want to work this out, being a home that you're going to live in, assuming you're going to live in it, and it's not going to be investment property in the future, is you want to get rid of that loan. There's no tax benefits, no benefit in having that loan for longer. It's going to cost you more money. So even not by borrowing to your limit, but by borrowing enough so you could pay it off quicker is where you want to work. So even when we're doing calcs, Josh, we'll try and look at like, well, if you make an extra $200 a week in repayments, you can pay it off over 20 years. And that's where we recommend you really need to work from.
And the biggest thing to take away from this is what the banks say you can afford and what you can afford are two totally different things. Everyone's got different living expenses. So realistically, you want to look and aim for a property or a loan you can pay off within around that 20 to 25 year mark. At that point, that's really going to be comfortable. So if rates were to increase, or your income were to reduce, or expenses were to increase, it's going to allow you not to have to be in a financial position where making repayments are going to be a little bit hard.
Yeah, and that's where people asked us before, is it 30% of your income, is it 40%? I think look at your own situation, look at your own living expenses, look at what you're going to sacrifice, and you don't want to be in a position where you've got no buffer. So you don't want to put all your eggs in one basket, leave a bit of wiggle room, and you can be more comfortable.
First home buyers don't pay their bills on time. And this one's going to kill your application, because essentially the banks are becoming more and more savvy with looking at your repayment history. Now it's up to 24 months of repayment history that's going to stay on your file. So by not paying your bills on time, this could be a disaster for your application.
Yeah, further to that, Josh, the banks are looking at overdrawings on your accounts. So even if you've paid your bills on time, if your account's constantly going over limit because you're taking too much money out of there, or you've got direct debits and you're not managing your money, it looks really poorly on you. Now, I had a question the other day and they asked, well, how many month statements do you give a bank? Generally, we'll give a bank between 3 to 6 month statements to show them your account conduct, etc., etc. But if you're applying through a bank that you've been a customer of for years and years and years, they're going to see the last 20 years of Joshua's history and know, well, every Thursday he runs out of money because he's spent it all on the week, and etc., etc. So you need to be careful of your account conduct as much as paying your bills on time.
And we've had yeah, that's right, Jayden. We had an example only recently where a customer of ours had issues 7 years ago with this bank. 7 years, but that was a long time ago. I mean, we all remember what it was like when we were in 18, 19, 20. Things change. Fast forward 7 years, we applied with this same bank. The bank they've been with for 20 plus years, and application was declined. The banks have very long memories. So even if the last 24 months has been clean, they still remember those days when you were a teenager. So beware.
Hello, Mindy.
First home buyers never attend the building and pest inspection. Getting a building and pest on an existing property is a must. What a lot of people don't realize is the real estate agent isn't a builder and they're not going to know structural issues. So they're not necessarily going to know issues with the place when they're advertising the property. Also, if they don't know, they're not going to be able to disclose it. So you need to get a building and pest inspector who's a qualified builder to go out and look for, leaky taps, moisture, white ants, bugs, creepy. If the building's going to collapse, the floor's going to go down. These are the people that go out there and look at these things. But the problem with that is they give you a report that's like a yellow pages, if you can remember one of those, thick with just info and disclaimers, and it's pretty hard to understand.
Exactly right, Jayden. And the report really is designed to mitigate litigation for the building and pest inspector. So when you are getting your building and pest inspection completed, the most important thing to do is actually attend the inspection. When you attend the inspection, what you want to do is have the building and pest inspector walk you through the report. When you walk through the report, a few of the things you want to do is ask the inspector, okay, that's an issue. How much is it going to cost to fix? Just an estimate. What happens if I don't fix it? And is it really a major issue? So what happens if it's not fixed? Understanding these items.
Yeah, because the reports can look frightening. They can say critical issue and it can just be like a tile that's going to fall off the wall or something pretty small. So understanding if it's life-threatening or life-saving, is the big difference between buying that property and maybe getting a bit of a discount, renegotiating, or just like walking away and leaving the lemon to someone else.
First home buyers go directly to their bank. Now, this is a huge mistake because when you're going directly to the bank, it's kind of like going to the used car salesperson and saying, hey, look, is this a good deal? Of course, a used car salesperson is going to say it's the best on the lot. Well, that doesn't necessarily mean it's a cheap deal. So what you want to do is a few things, Jayden.
Even before we talk about the costs and the numbers, I think with the intricacies of lending these days, there's some banks that are really good at certain things. If you're a contractor, or if you get bonuses, or if you're buying a unit or different things, and there's some banks that are terrible. So having someone that can kind of traverse that whole market, look at all the intricacies, then find you the absolute best deal is important. Again, like you said with the pre-approval point, the market's fluid, it's changing all the time, and just because a bank might have a good day today, might be different. So
So what you really want to do here is utilize the services of a broker. A mortgage broker is like a doctor, a specialist. If you're going to go for a surgery and it's an intricate surgery, you don't want a general practitioner. You want someone that's a specialist who just does one thing and one thing alone. And that's what a mortgage broker does. They only deal with mortgages. What a mortgage broker essentially can do is shop the market of an array of products and find you the best deal.
Yeah, if you need help from a mortgage broker, that's us. We'll talk to you.
The next mistake first home buyers make is fixing their mortgage. And this is a big one. This is a pet peeve.
I'm going to disagree with you, but anyway, you talk about why, and then I'll talk about why I disagree. In the current market, this is a fluid thing. So if you're watching this video in a few months' time, it could be completely different. Look, say your piece.
My big thing is that when you're fixing in your home loan, it's really your bet versus a bank. The bank wins if when you fix in the interest rate actually decreases. They make margin. You're paying a higher rate than the variable rate they're offering. You win if the variable rate increases because you're getting a lower rate than what the variable rate is currently being offered. So for me, my thing is that the banks with all their resources, all their power, are going to know what the market's doing. So it's really your bet versus the bank. And for me, the bank being the dealer, I don't like my chances.
I think there's two things. I think you need to look at the fundamentals. So the positives of a fixed rate are you can protect from rates going up. You can help budget. So if you're really fastidious on, I only want to spend $300 a week on a loan, fixed is great. The downside to fixed is that, like Josh said, it's a bit dealer wins and you're limited in how much you can make in extra payments. Depending on the bank, that can be anywhere from $5,000 to $10,000 a year in extra payments. So effectively, by fixing your rate, you're potentially locking yourself into being limited to paying your loan off over 30 years. It's a bit of a limiting thing. So it's hard. In the current market where the fixed rates are a little bit lower than the variable, you might want to fix a bit and not. It's going to be case by case. So I think, like Josh said, it's going to depend on your situation. You need to sort of look at, well, what's your short, medium term, longer term goals? And if fixing some makes sense, you can do a bit of a best of both worlds. You leave some variables so you can pay that bit off, and you can leave some fixed so you can get the benefit of the rate or potentially trying to take a bit of a gamble on the market.
And remember, hit that subscribe button below to keep up to date with all things property and finance. The next mistake is that first home buyers don't prepare before getting a mortgage. Remember that getting a mortgage and buying a property is a lifelong journey. And as the saying goes, proper prior planning prevents poor performance. So if you're planning in advance, what you want to do is set yourself up with a mock mortgage. And a mock mortgage is a fancy way of saying what your mortgage repayments will be and whether your rent plus your savings equals that figure. And if you're doing that, you'll know that you're going to have no problems in managing your mortgage.
Plus there's all the extra costs. You got to remember there's insurance, there's body corporate sometimes, there's maintenance, there's other stuff involved when you own a property. So the mock mortgage definitely helps, and then having a bit of a buffer there makes you bulletproof. It's going to make you fine when you actually, it's like your home loan and training wheels, like you like to say. For more details on how to set up your mock mortgage, check out the video in the link below. Camera around, battery, let's keep going.
So the next mistake they make is that they don't budget.
Josh, I'll be honest, when I got my first place, budgeting felt like a bit of a dirty word. And it was a case that I was kind of like, well, the bank will give me the money, I'll be fine. But rates actually went up and I kind of got myself into a bit of a pickle. So budgeting and planning around that is really important before you get a mortgage. The mock mortgage helps. What else can you do to get prepared?
The easiest way to get your finances in check is with a bucketing system. We did a whole video on this, so if you want more information about that, link in the description. The other thing you can do is when you do your budget, look at things where you can stop, change, reduce, or continue. So for example, if you've got a gym membership, if you haven't been to the gym for 3 or 4 months, maybe that's an easy win to stop and to increase the cash flow. The next mistake first home buyers make is that they don't have a conveyancer. A conveyancer is essentially the oil within an engine and is going to make your life so much easier. Jayden, we've had some horror stories of people self-conveyancing, haven't we?
Jesus. Horror stories, nightmares. So a conveyancer is a property lawyer that's there to protect your interests. And yeah, Josh, I've had clients that have tried to self-represent because at the end of the day, it can look like an easy job. They're just getting a check from the bank and then handing it to the sellers and saying like, thanks, see you later, we'll transfer the title, and it's that easy. It's not that easy.
And having a bad conveyancer will help create a lifelong memory, and not in a good way. So when looking for a conveyancer, the first thing you want to do is get a recommendation from your broker. The second thing is check them out on Google reviews and Facebook. See what their clients are saying about themselves. And from there, make your decision. That easy.
It really is, actually. Just don't do it yourself.
The next mistake is first home buyers buy off the plan, and this is a big no-no, isn't it, Jayden?
Listen, Josh, it can go really well. Often it doesn't go really well. Buying off the plan means that you're signing a contract for a property today that's not going to be ready to move into in years in the future. And the tough thing is with contracts these days, it can be up to 5 years before you actually move into that property, which means stuff can change a lot. The other thing is you generally have to put down like a 5 or 10% deposit today and look to settle in the future. That's not the tricky part. Josh, what is?
Well, a few things. The market can change. So if the market was at its peak when you bought and now at its bottom, well, it means you'll need a much larger deposit. Secondly, the lending landscape is forever changing. Well, in short, it might mean that you're eligible now. Nothing might change for you, but the lending's parameters have. And at that time might mean that the banks can't help. So understanding all the intricate details when looking to buy off the plan is paramount. We've done a full video on this, so link in the description.
Oh man, first home buyers buy land and expect everything to be hunky-dory.
At the moment, what we're seeing is a common mistake is first home buyers are buying land and then months later trying to build, and the valuations are falling through. Essentially what people are spending on the property and what it's valued at are two different things. And that essentially means one of two things. Either needing a much larger deposit, or the bank is unable to help because their lending margins don't permit. So as a first time buyer, there are a few things you can do if you are looking to build. They include:
the silver bullet here is settling your land and building at the same time. It's good for you as the first home buyer for a couple of reasons. One, you don't settle land and start paying a mortgage on it while you're still renting and while no one's building on it. It's just going to cost you more money. The second thing is it hedges that valuation risk that Josh said. So if you're getting the land and construction at the same time, the bank will get their valuation all at the same time, and they'll value the property as if complete once it's constructed. And if that comes in short, you can at least walk away and say no thank you. If it comes in fine, you're good. More on that first point is cost. It's going to cost you less money if you can push back the start date. You're going to build faster and get into that home way quicker.
And the final point is that first time buyers make their decision purely based on interest rate. With so much changing in the market at the moment, interest rates aren't a great indication as to whether or not you should apply to the bank. It's because the lending parameters are changing.
So I had a good example of this the other day. One of the big banks introduced this crazy intro rate. They introduced a variable rate of 2.19%, which is like 0.5% below most of the other banks on the variable rates. The trap is it's an introductory rate. So after 2 years, that rate goes up to something in the nosebleeds. Now the secondary trap there is that if you have less than a 20% deposit, you might be stuck there. So once the introductory rate is gone, well, you're left with the higher interest rate. So beware, don't make your decision purely based on the interest rate. And that's it for today, guys. I hope you enjoyed the video. If you did, make sure you like and subscribe. Leave a comment below. Which was your favorite mistake? Have you made one? Be honest. I'll find out. No, I won't. Anyway, have a good day. Catch ya.